Welcome to MacroPulse Business. Today is May 6th, 2026, and 5 simultaneous macroeconomic signals are reshaping the global investment landscape right now. Over the next 8 minutes, I will walk you through each signal using the same institutional frameworks applied by Goldman Sachs, JPMorgan, and the Federal Reserve. All data is cross-verified from primary sources, including the Federal Reserve, World Gold Council, Energy Information Administration, Bureau of Labor Statistics, Bureau of Economic Analysis, Korea Exchange, and CoinMarketCap. Here are the 5 signals. The Federal Reserve confirmed the neutral rate. Gold held near record levels. Crude oil suffered its largest single-day decline in months. Big tech committed $795 billion to artificial intelligence infrastructure, and South Korea's equity market reached an all-time high. Let us decode what each of these means for your money. Chapter 1. The Federal Reserve. On April 29th, the FOMC held the federal funds rate at 3.50 to 3.75%. This was universally expected. But the language Fed Chair Jerome Powell used in his press conference was historically significant. He acknowledged that current rates are, quote, in the vicinity of neutral. That single phrase tells institutional investors everything they need to know. It references the Wicksellian neutral rate, the theoretical interest rate first defined by Swedish economist Knut Wicksell in 1898. The neutral rate is the level at which monetary policy neither stimulates nor restricts economic activity. By confirming proximity to this equilibrium, Powell signaled that the hiking cycle that began in March 2022 is functionally over. What comes next is patience. The Fed's forward guidance was deliberately vague. No preset path, meeting by meeting, data dependent. This preserves optionality, the ability to cut in June if inflation falls, or hold through summer if it does not. Markets currently price a 62% probability of a first 25 basis point cut by September 2026. Taylor Rule analysis supports this direction. With core PCE at 2.6% and real GDP at 2%, the Taylor Rule prescribes an optimal funds rate between 3 and 3.5%, modestly below current levels. The Fed is applying a controlled brake, not an emergency brake, not acceleration, just measured pressure on an economy that has slowed but not collapsed. Chapter 2. Gold at $4,680 per ounce. Let me give you the institutional framework. Gold does not trade on sentiment alone. It trades on 3 variables: real interest rates, central bank demand, and currency confidence. Today, all 3 are aligned bullishly. Real interest rates are the primary driver. When nominal rates sit at 3.75% and CPI sits at 3.3%, real returns on cash approach zero. The opportunity cost of holding gold, which pays no yield, disappears entirely. This is why gold outperforms during periods of financial repression. The World Gold Council confirmed 1,231 tons of global demand in Q1 2026. Total value, $193 billion, the highest quarterly demand value in recorded history. Chapter 3. Crude oil. WTI fell 5.76% to $96.38. Brent fell nearly 6% to $103. This is a large single-session move. Here is the mechanism. Since February, oil markets had embedded a significant risk premium, an additional price cushion traders demanded because of Iranian supply disruption risk. The Strait of Hormuz, through which approximately 21% of global seaborne oil trade flows, was under operational threat. Diplomatic reports on May 6th indicated that informal U.S.-Iran back-channel negotiations produced a framework pausing hostile naval operations. Geopolitical risk premiums do not bleed out slowly. They collapse suddenly. Today was that collapse. The inflation implication is direct. Sustained crude at $93 to $97 would mechanically reduce U.S. headline CPI by approximately 0.3 to 0.5 percentage points over the next 90 days. Chapter 4. $795 billion in artificial intelligence infrastructure. Amazon is committing $200 billion. Microsoft, $190 billion. Alphabet, $185 billion. Meta, $135 billion. This is the largest voluntary private sector infrastructure commitment in modern economic history. The Keynesian investment multiplier for productive technology infrastructure, data centers, semiconductor chips, cloud computing, and software engineering runs approximately 3 times the initial investment. $795 billion multiplied by 3 implies an estimated $2.4 trillion GDP impact over a 3 to 5 year deployment horizon. This is a structural positive demand shock to the broader economy. The critical institutional question Goldman Sachs has raised, is this rational capital allocation or competitive fear-driven overinvestment? The race to build AI infrastructure may be driven as much by existential competitive fear as by financial logic. Chapter 5. Global Markets. The headline story is South Korea's KOSPI index reaching 7,384, an all-time high. This matters globally because South Korea is the world's most sensitive barometer of trade normalization. Samsung and SK Hynix collectively control 45% of global DRAM memory production. Their order book visibility is directly tied to US-China trade relations. The KOSPI all-time high tells institutional investors that the trade framework agreement has been validated as structurally durable. In the United States, the S&P 500 crossed 7,200. NASDAQ reached 25,800, driven by AI earnings tailwinds. Bitcoin held above $80,000 with 60% market dominance, a signal of institutional rather than retail conviction. Ethereum traded at $2,370. Chapter 6. Recession Risk. Goldman Sachs places the 12-month probability at 30%, JPMorgan at 35%, the IMF at 35%. These are not alarmist figures. They represent a genuine tail risk, not the base case. The base case remains continued growth, albeit slower. U.S. GDP grew at 2.0% in Q1, above stall speed, but below the pre-tariff trend rate of 2.5 to 3%. April non-farm payrolls added only 70,000 jobs, less than half the 150,000 consensus estimate. Unemployment reached 4.3%. CPI remains at 3.3%. The Federal Reserve faces a structural dilemma. Inflation still above target, growth clearly decelerating. The critical question, will the first rate cut be precautionary, extending the expansion, or reactive, responding to a recession already underway? The answer depends on CPI data releasing May 13th. Chapter 7. Your week ahead watch list. 6 indicators that could move markets between now and next Friday. First, U.S. CPI on May 13th. A print below 3% would signal the precautionary cut narrative and likely push equity markets higher. Second, FOMC minutes on May 21st. Watch for the balance of hawkish versus dovish voices. Third, Bitcoin post-halving supply dynamics at the $80,000 support level. Fourth, EIA oil inventory data for Iran's Strait compliance signals. Fifth, Bank of Japan policy communications as the yen approaches 157. Sixth, final S&P 500 Q1 earnings, specifically whether companies report AI revenue generation or continued pure cost center status.